Let's dig more into the numbers with UBS bank analyst Erika Najarian. Erika, great to see you as always. Thanks for the help today.
Absolutely.
You want to tackle this Wells guidance and whether the stock is reacting appropriately?
Yeah, look, it's a day of really tough comps for Wells. I'm not really surprised by the stock reaction. Essentially, Wells Fargo lowered its net interest income guidance because it's getting a little bit more, markets or trading NII as a factor, which we're not used to at Wells. And markets tend to benefit from rate cuts, which we are pricing out of the curve. So that's really what's happening at Wells Fargo. But then you have JP Morgan blowing out numbers and increasing its net interest income guidance, and Citigroup going to the high end of its total revenue guidance. So Wells is just not comparing well to its peers today.
Is your framework changing to where, as we say, net interest income might be less of a factor and we're looking more to IB or certainly the IPO pipeline, M&A, things like that?
Look, I think the framework is not shifting as much despite this Wells Fargo miss. I think that activity levels in the second half of the year sound like they're going to impact net interest income and investment banking and trading. So you may have seen, the beats in investment banking, and a lot of that seemed to have happened late in the quarter. But you also saw a pretty nice pickup in commercial growth, and you're seeing pretty healthy card growth still, really talking to the resilience of the consumer in terms of spend levels in the second quarter. So I think the outlook for both net interest income and the fee income side look pretty okay for the second half of the year. I think Wells Fargo is just a little bit of an anomaly, given sort of what it was expecting for the rate curve to begin the year.
Is that so? I just want to dig into that a little bit more, and we'll talk to Mike Santomassimo next hour. But so it's because of expectations. That's why it was such an anomaly on net interest income?
Yeah, so I think what Wells was expecting were more cuts, and more cuts tend to benefit the trading contribution to net interest income because it's what's called a liability-sensitive business. So as soon as you take those cuts out of your expectation, it actually goes more into fee income rather than net interest income. So part of this is actually there's a little bit of EPS neutrality in terms of like the geography of where trading is going to land because of rates. However, if you're just looking at these three banks and just looking at the headline results, Wells just doesn't compare well because it's the only one that took down expectations versus JP Morgan and Citi, who actually went to higher expectations or to the top end of their previous expectations.
Hey, finally, Erika, cost controls, would you describe them as net impressive across the board? And is that a function of the way in which these banks are folding in technology?
Here's some good news for the banking sector. The fact that we're not talking about expenses or focusing on expenses so much, I think really speaks to some of the revenue outperformance in this quarter and what's to come. I think to answer your question about technology, some of this deregulatory momentum could actually free up some of those related expenses and will allow banks to continue to reinvest in revenue generating businesses and continue to invest in technology. I think costs were pretty in line with expectations, but really these banks have not so far gotten a lot of questions on that because the focus is really on revenue performance for the second half of the year. And that's why Wells is underperforming so much. And also, how to deploy all this excess capital that's all of a sudden getting redefined by a new regulatory construct.
Right. Fascinating. And it's just day one. There's a lot more to come tomorrow. Erika, appreciate it. Talk soon, I hope. Erika Najarian.